The last 2 months have seen an incredible rally in the stock market in the midst of a downward trend, which is maybe leading investors to get a little bit too comfortable and confident that the bear market is over, that the Fed will actually initiate a soft landing, and that they're not going to throw the US economy into a recession. But let's take a look at what's really going on here. In early February, the Fed raised interest rates by 25 basis points. Now, this was their smallest rate hike yet, which leads the market to believe that the Fed will pivot by the end of the year, and they're pricing in that optimism. And while we all like to see our stocks going up, Jamie Dimon, one of the most respected men on Wall Street, the CEO of JPMorgan Chase, came out and he said, "Everyone needs to take a deep breath here and pause before we declare victory. All experts are agreeing that this rally will be very short-lived because of sticky inflation." Now, we just got the new CPI numbers that came out this week, and it showed that in January, inflation is actually worse than expected. Inflation is holding fast. It's not getting any better despite the Fed's best efforts. Now, the blame can be cast on the rally in the stock market, and we see that the Fed will have to come after the economy and the stock market with a sledgehammer if they want any hopes of making inflation something that doesn't become an unsolvable problem in the future for them. They have to get the market to come down for inflation to cool. And the higher than expected jobs report that just came out is giving the Fed the bargaining power that they need in order to raise rates longer and raise rates higher, which means that when the recession does come, it will be deeper and longer, creating more pain for US investors and workers. Another thing to consider is that the CPI numbers that we're getting are really only taking into account what's called Supercore inflation, and that's the service industry minus energy and minus housing, which are two of the biggest indicators of where the economy is actually at. And when we look at that, the number has only come down from 7% to 6.3% over the last year. All of the signs overall are pointing to inflation being much stickier and harder to get rid of than what was first hoped for. Now, the chief US economist at Morningstar came out and he said, "I don't see how you can get rid of inflation without a recession. The stock markets and equities will be disappointed either by earnings or inflation, one way or the other." Now, in the midst of this, investors are beginning to move into real assets as the Fed and Wall Street wake up to the real dangers of inflation here. And if you're concerned about where this is going and you're looking for ways to get protection on the table for yourself, I'm Makai Block with American Hartford Gold. Give us a call today, and we'll talk to you about how putting physical gold and silver into your portfolio can protect you against what's coming in the economy.
Discover how gold can help you protect yourself and your family. Call today or visit our website for more information at AmericanHartfordGold.com.